Meet Tommy. Tommy works 9 to 5. Tommy pays rent. Tommy pays bills. Tommy is tired. Every month, money goes out. But one day, something strange happens. Tommy checks his phone, and he sees a notification. You've received a dividend. Tommy freezes. Wait, I got paid? For doing nothing? Yes, that's dividend investing. And in the next few minutes, I'm going to show you exactly how it works, in the simplest way possible. Let's start with the basics. A dividend is money a company pays you for owning its stock. That's it. When you buy a stock, you're buying a small piece of a company. If that company makes a profit, it can either reinvest the money or share some of it with shareholders. When it shares the profit, that payment is called a dividend. Many large companies do this consistently. Companies like Coca-Cola, Johnson & Johnson, and Procter Gamble. They've paid dividends for decades. So if Tommy owns shares, Tommy gets paid. Even if he's sleeping, even if he's on vacation, even if he's doing absolutely nothing. That's powerful. Now let's break down how dividend investing actually works. Step 1. You buy shares in dividend-paying companies. Step 2. You hold them. Step 3. You get paid quarterly. Most companies pay 4 times per year. Step 4. You reinvest those dividends. And Step 5. You repeat that process for years. This is where compounding begins. Your dividends buy more shares. More shares pay more dividends. More dividends buy even more shares. It's a snowball. At first, it's tiny, but over time, it gets massive. Now let's talk about dividend yield. Dividend yield tells you how much income you earn compared to the stock price. Here's the simple formula. Annual dividend divided by stock price. If a stock costs $100 and pays $4 per year, that's a 4% yield. Simple. But here's the warning. If you see a stock paying 12% or 15%, be careful. Sometimes a high yield means the stock price crashed, and that could mean trouble. A high yield is not always a good sign. Always check if the company can actually afford to keep paying it. There are 2 main dividend strategies. The first is high-yield investing. This focuses on stocks that pay large dividends right now. The benefit? More income immediately. The downside? Higher risk. Dividends can be cut. The second strategy is dividend growth investing. This focuses on companies that increase their dividends every single year. Companies like Apple Inc. and Microsoft. They may not pay massive dividends today, but over time, that income grows, and growing income is extremely powerful. Let's quickly cover the pros. Dividend investing creates passive income. It takes advantage of compounding. It's usually less stressful than constant trading, and it encourages a long-term mindset. Now the cons. It's slower than aggressive growth investing. Dividends can be reduced during hard times, and in some accounts, you may owe taxes on dividend income. It's not a get-rich-quick strategy, it's a get-rich-slow strategy. But slow and steady wins more often than hype. So how can Tommy start? First, he opens a brokerage account. Platforms like Fidelity Investments, Charles Schwab Corporation, or Vanguard Group make it easy. Second, he chooses either individual stocks or dividend ETFs. If he wants simplicity, he might choose something like Vanguard Dividend Appreciation ETF, ticker VIG, or Schwab US Dividend Equity ETF, ticker SCHD. These funds hold many dividend companies in one investment. Third, Tommy turns on DRIP. That stands for Dividend Reinvestment Plan. This automatically reinvests dividends into more shares. No manual work required. And finally, he stays consistent. He invests regularly. He reinvests dividends. And he thinks in decades, not weeks. But Tommy must avoid common mistakes. Don't chase extremely high yields. Don't put all your money into one stock. Don't panic sell. And always check the company's fundamentals. Dividend investing rewards patience, not emotion. Fast forward 20 years. Tommy kept investing. He kept reinvesting. He stayed consistent. And that tiny dividend stream turned into a waterfall. Not overnight. Not in a year. But over time. And that's the real secret. Dividend investing isn't about getting rich tomorrow. It's about building income that grows with you. So the real question is, are you building for growth, dividends, or both? If this helped you understand dividend investing, you already know what to do. And I'll see you in the next one.